Now we will prepare for the bit of the stage because of the panel discussion is going to start. So stay tuned, and it's a great opportunity to learn.
I'll do the moderating. I'll do it up here. Hi, everyone. Welcome to the Investor Sessions part of this ETHVC Summit. Thanks to Kindo for kicking us off, as well as our sponsors, Farah, Zaleo, and SuperNet. I'm going to kick us off with a quick primer on the state of VC before we dive into the investor sessions. So hi, everyone. I'm Tina. I'm part of Bufficorn Ventures. And Bufficorn Ventures is actually the investment arm of ETHDenver. I'm one of the investment stewards alongside John, who is the founder. For those of you who don't know, we started Bufficorn Ventures because ETHDenver is one of the longest running hackathons, as well as one of the largest communities. And we decided to come together with this small investment arm where we invest in early stage seed, pre-seed deals alongside other VCs. So we do follow-on checks up to 100,000, and we back founders with the reach of our global community. If you want to learn more about us, you can check us out, bufficorn.ventures. And with that said, I'm going to start us off with a quick primer on the state of VC. And this should be good context for our next series of conversations. So in 2025, where we were in terms of VC capital deployment, we deployed about $20 billion across 1,600 plus deals. And this is actually one of the better years of fundraising, aside from the heights of 2022. This amount of capital deployed was double that of 2023. So we are seeing an uptick in the amount of capital deployed. However, if you dig a little bit deeper into the actual number of deals done, you'll see that deal count in 2025 is actually trailing some of the prior years, which means that the amount of money raised per deal has actually increased by a significant number. And when you dive more into that, you can see that more money is actually flowing now into later stage companies than earlier stage companies. And this is true both by the amount of capital deployed per deal as well as the number of deals. And you'll see here in 2025 versus that of 2024, 2023, it's almost 60% of capital has gone into later stage deals, which is double, even triple that of prior years. And if we now dive into capital deployed by the actual category of what people are investing in, it seems like centralized exchanges and other exchanges are the perennial business model for crypto. And so that first large bar, it's really exchanges, lending, investing platforms, trading, and everything else is sort of more or less the long tail of investments. And just as a whole, I know I'm going through this all super fast. As a whole, it seems financial utility, right, including payments, including banking, as a whole is getting a lot more momentum in 2025, while you see a decline in infrastructure as well as consumer categories. And another interesting note for the state of VC in 2025 is we actually have a lot more M&A than we have in previous years. So you'll see that M&A count, it has reached an all-time high. And this is led by acquirers like Coinbase, Ripple, Kraken, Stripe, et cetera. So with that said, that is the primer for the state of VC where we were in 2025 relative to all the other years. we have 2 upcoming panels. The first is going to be fundraising across the capital stack. And this is going to be a crash course on what VC math looks like, as well as what it might take to raise in 2026. And then the second panel after that, we are going to have a request for startups. So this is an unfiltered look at what VCs are now looking to fund today. So with that, I am going to invite up our first set of panelists. We have Richard Chen from Veric. Please come to the stage. Kara Vogel from Six-Man Ventures, and B. Fatsi from Faction. I actually need a mic. On, but then we'll get started. Oh, it is on. Perfect. All right. So we have about 25 minutes to decode the capital stack. So I wanted to first start off with a quick calibration question. Would love to have you guys introduce your fund and give me a sense of the sweet spot of the check size and stages that you guys played in. We can start with B. Okay.
Oh, ladies first. I love it. Hi. Is this on, by the way? Okay, great. B. Fatier. I'm the co-founder of Lightspeed Faction. We are an early stage blockchain-focused fund that is a joint venture with Lightspeed Venture Partners. Our fund is about $285 million. We are focused primarily on Series Seed and A. Sweet spot of checks is between $5 to $8 million. Sometimes we'll go a little south of that. Sometimes we'll go a little north of that. And we invest across the stack, so we'll invest in both equity and token projects.
Hey everyone, I'm Richard. I run a fund called Veroc. It's a $30 million fund. Check size 600 to 900K, and investing pre-seed, seed, kind of anything that touches crypto. So it can be crypto native projects like exchanges, DEXs, lending protocols. It can be crypto adjacent like payment providers, stable coins, a little bit of AI robotics. Yeah.
Hello, everyone. My name's Carl. I'm a general partner at Six-Man Ventures. We're an early stage venture fund that writes checks between $500K to $5 million in pre-seed to Series A companies. Our general thesis has been to focus on the application layer versus infrastructure. Generally, our opinion has been for years, we don't just need to create more block space, we need things that actually utilize the block space. We started that fund about 5 years ago. It was very contrarian at the time. Now we see more and more investors funding apps as well, and we're starting to see a great app explosion in the crypto ecosystem.
Cool. So I'm going to ask you guys questions in sort of 3 sections. The first section is going to be about the VC business model. A lot of these questions I'm directing towards Richard, but feel free to pitch in if you guys have other thoughts. So we'll start with the VC business model. So Richard, I would love for you to explain what the VC business model is, right? Because when we talk about pitching, founders need to kind of understand what the VC business is. So how do you actually return a fund? And what is the return that LPs are sort of expecting at the end of a fund lifecycle?
Yeah, so I'd say the root cause of all this is the power law. So like, in case you're not familiar with the power law, there's only a small handful of companies every year that produce most of the returns for that given year. So like, if you look at an overall VC portfolio, say like 10 companies, maybe 5 of them will lose money. Then like 4 of them will make 1x or like a couple x, and like that one company will turn like 30x or more, and like that one company makes or breaks their fund. And like this is why, because of this, VCs care about TAM, outcome size, how big can these companies grow? Because in the small probability that the startup is successful, it needs to get to the size where it can be a massive 30x outlier outcome. So I think this is where there's a big difference between VC-backed startups and like small businesses. So like for most companies, like they don't need to raise VC money. You can get to 7 figures ARR bootstrap like by being like a good profitable business. But like when you take VC money, VCs are expecting you to grow to like 100 million plus ARR, where you're now a candidate to IPO or have a huge multi-billion-dollar exit. So because of that, this is why VCs care a lot about TAM. How big can this company grow? That drives a lot of the returns, the business model of venture, because most of the returns are just concentrated in just a select handful of outlier companies.
Thank you for that. So, it depends on the actual fund vintage, but typically I think top quartile is a 4 to 5x return on the fund, which informs a lot of the portfolio math, right, that you're looking at. So you actually write a lot about portfolio math, Richard, and you sometimes argue that while many founders actually optimize for the highest valuation, this is a valuation trap. Can you explain why too high of a valuation might lead a VC to potentially pass on a company?
Yeah, so like VCs are always like paying like up for valuations relative like to today's like revenue. So like say you get a term sheet for at say 100 million valuation for like 1 million of ARR. And like, that's a 100x revenue multiple, which is crazy. But, VCs are paying up that you're going to 10x your revenue in the next few years. So like all of a sudden that 100x multiple becomes a 10x revenue multiple. The risk of raising too high of a valuation is if your growth rate slows and you don't grow from 1 to 10 million ARR, then all of a sudden you're left with this huge valuation overhang. No VC will want to touch you for your next round. It basically kills your next round of fundraise. So like I've seen this happen a lot with companies, especially in 21, 22, when like it was a very easy time to fundraise. A lot of companies took these very high valuation term sheets, was never able to grow into the revenue to justify these valuations. Now they're running out of cash. They need to go and fundraise, yet no VC will touch them because now VCs have moved on. They're funding Anthropic, OpenAI, the next hot companies. You're kind of left for dead. So this is the risk of taking too high of a valuation that you don't think you can grow into next few years.
Great. And so last question for you, Richard. For founders thinking about pricing, what's your heuristic for how they should think about pricing?
I guess it really depends on like the market you're building in. I guess what I'm seeing now, like pre-seed is probably like sub 20, and then seed is like sub 30, and then Series A is between like 50 to 100. But it's also obviously like very dependent on the market you're building and like what the comps are. Like U.S. valuations, Silicon Valley valuations are going to be higher than like emerging markets, for example. So it's very dependent.
Thank you. So now I'm going to move into this next section, which is graduating from pre-seed to seed, and a lot of these questions are going to be directed towards Carl. But again, if you guys have other perspectives, feel free to chime in. But pre-seed and seed often just sounds like nomenclature. And so the expectations, though, from a VC perspective can be vastly different. Can you help founders think about how they differentiate between pre-seed and seed, and maybe is pre-seed simply just buying, the team and the dream, or the seed stage requires more of hard data? Like, how do you think about the difference between a pre-seed and seed company?
To be honest, I don't think about it much. And like, we actually have an internal tracker, and I list this as pre-seed or seed, and like, it's actually hard to tell. Like the general heuristic I would use if there's one thing is, do you have a product that you are offering to the market? If you're a pre-product, you have nothing built or nothing that's ready to go live, then you're absolutely pre-seed, in my point of view. Seed companies usually have a product, they have customers, they have a pipeline that they're aiming to sell into, but usually they have not achieved product market fit. Some have, some haven't, but usually it's so early in the company's life cycle, it's hard to discern do they have real product market fit. So as an example, if you're a software company, you might sign 10 customers, be like, oh my gosh, I have product market fit, but then 9 out of the 10 churn 3 months later once your contract is up. And so really what we're looking for is, do you have a product in market that has a clear value proposition that customers in the market are willing to engage with or buy? And that all of a sudden means, okay, this is actually a seed type company. Versus something that's pre-seed. But at this stage, I think it's really collapsing. I mean, I look at it now, if somebody comes to me and has a deck but no prototype, in the age where I just rebuilt our entire CRM in 3 days, I'm like, why don't you have a prototype of this product? It's almost like pre-seed doesn't need to exist to the same extent it did before, because the pace to prototype and build and test hypotheses has absolutely collapsed with the use of agentic coding.
So that's actually a good tailway into my next question, right? Because the fundraising data does show that more and more capital is moving later stage.
Yeah.
And so curious, what's your sense on the ground? And also, has the bar fundamentally raised for a seed or a pre-seed deal to get done?
I think absolutely. I think that there's a big sobering that's going on amongst like the venture capital industry. Before it's like, oh, you have this new app that is something to earn. Of course, it's going to be worth $1 billion. And I think over the past few years, we've really come to senses that it's very hard to have a $1 billion+ outcome that sustains over a period of time, such that as an investor, you can actually exit that position when the time is right. Things tend to spike and then go down, and so usually investors are locked up for a period of time, as they should be. But as part of that, it means we need sustained, durable value creation. And so with that, it's very hard to build and launch companies that actually can do that at scales of hundreds of millions or billions of dollars. So it's definitely moving. The other thing too is we've now have a lot more great builders that were funded and came into crypto 2020, 2021, 2022, and now they've continued to scale, and so they need more capital. So it's just a function of investing in the market over time. There's now naturally more legitimate Series A+ companies than there was previously. Just like last cycle, we had very few public crypto companies, but now you can point to 10+ crypto companies that are public. So it's just the industry maturing over time.
Yeah, that makes sense. So what does it actually take now to graduate to a seed from a pre-seed, right? Is there a specific threshold that you're looking for in terms of ARR, or how do founders think about when they're seed ready?
I would say it really depends on the category. So if you're doing software as a service or some software platform, that's a very different set of heuristics than if you're building AI research models. You're more like a research lab in terms of where that cutoff is. My biggest piece of encouragement would be raise capital when you actually either need the capital to scale your business and you know exactly how you're going to allocate it, or the market actually suggests now is the time to raise capital. So this is something like interesting for the builders out there. Sometimes the market, a certain segment gets really hot for 3 months. I mean, Bitcoin L2's had its moment, restaking had its moment. These are things that nobody talks about now, but like there was periods where there was so much demand amongst investors, not us, but like other investors for these categories. And so when the market is telling you to raise, absolutely listen to that signal and get cash in the door. Don't go spend it frivolously, but actually use the market volatility to your advantage as a founder to try to get a healthy valuation where you don't need to have a ton of dilution. Now, you don't want to over raise, such as some of the concerns that were discussed before. It's going to be harder to bring on teammates, et cetera. But the worst possible thing is that you were in a market that was really hot, you didn't raise, and then all of a sudden that market has cooled down and there's no investor appetite and you're running out of cash. And so really it's just about, when do I need the cash? How am I going to allocate it properly? Go to the market's going to tell you amongst VCs, like, is there a demand for this type of deal or not? And the other thing I'd say lastly to that is the market changes. And so there's tons of founders we talked to, and it was either too early or we just didn't have enough conviction. 3 to 6 months later, we end up investing. So maintain great relationships with venture. We are on your side, truly. We all want to win together and scale crypto. So if it's not right at that one point, maintain a healthy relationship, and then it might work out in the future.
One more question for you.
Yeah.
There's a ton of firms now in crypto, like 6man Ventures, that are starting to look at frontier tech, right, broadly, more with like AI, robotics, et cetera. Just wanted to get your thoughts on how founders should think about that as a signal. Is the attention diverting away from crypto, or why are funds making that decision?
Yeah, and what I'll say is we look at the intersection. So if crypto is not foundational to a company, then we are not world-class enough to probably find the best deal. So let me give you an example. If somebody comes to Six Man Ventures and says, I have a robotics idea, but as a firm, we've put out 0 thought pieces on robotics. I've attended 0 robotics conferences. We're not actively in Telegram groups talking about robotics on a regular basis, pure robotics. Like, if I see a deal, it means that all the other people that have a right to win that deal first have passed. So we really try to stay focused on crypto, or where crypto intersects different categories, and try to be world-class there, because we know we have a good chance of seeing world-class deals. So if you see a firm that's chasing the next thing, again, robotics is hot right now. If you see a firm chasing robotics, chasing parts of AI, chasing other things, it's a really bad sign that that firm actually doesn't have a foundational thesis. So really look for people that have been writing, thinking, investing in a category for a period of time, because they're also going to be smarter and more helpful to you as an investor. They're going to have more connections. They're going to have more insights, et cetera.
Thank you. So B, we're going to move on to your section, which is Series A and beyond. I think the first question here is really, we're entering a phase in crypto where there's more of a flight to fundamentals, right? And Faction itself is part of, or a partnership with Lightspeed Ventures, which is a very traditional Web2 fund. So when you look at crypto Series A and beyond today, have you completely reverted to Web2 metrics, or are you still assigning some crypto premium outside of those hard, like strict ARR multiples?
Yeah, I think it candidly very much depends on the complexion of the business and the category. I'll give you a few examples. We have invested in pieces of infrastructure that candidly have outsized strategic value. They are an N of 1 company, or they are an N of 2 company. And we have never valued them, even at a Series C, Series D, purely on their sort of monetization metrics, right? It's always with an eye towards what's the eventual outcome, and if that outcome is, say, a strategic acquisition that we think could be in the billions of dollars, obviously we're less focused on things like ARR, right? So that's just one example of when the ARR heuristic kind of falls apart. I think where there is probably, when you talk about a crypto premium, historically, people have looked at comps in the token market, right? And we knew that there was a outsized speculative bet that usually kind of threw some of those comps out of whack. I think, again, that gap has probably closed because the speculative bid these days has disappeared. So I think we are razor focused on more sustainable protocol revenues. We always say, by the time you're at our door, obviously we have the benefit of this, the pre-seed and seed investors and what they have kind of seen, but you have to be useful to someone. And if you're not starting to kind of really show that you are, providing some level of utility, and that you're at sort of the beginnings of inflecting on some metric that matters to your business. Now, again, that could be ARR. It could be, hey, you look at the TVL we've been able to amount. It could be, like I said, this kind of strategic value that you can point to, or logos that are very difficult to maybe, be able to get us customers. So there's no cookie cutter answer, but we are looking for breakout companies, right, where we can, at least point to a handful of metrics that show that there has been progress made from previous rounds.
Thank you. And obviously, stablecoins and RWAs have really caught the attention of all of crypto and Web2 fintech, right? So I'm curious if you're seeing more Web2 founders entering this space, and how do you think crypto founders compete with Web2 founders?
We have, definitely. I think the complexion of founders has changed. I've been in crypto since 2016, and I think, we started off with, a lot of builders that were sort of philosophically aligned with what crypto had to offer. A lot of it was sort of fringe movements, fringe builders. That was sort of where the industry really started. Then we kind of moved into this, and this is sort of thanks to some of the things that were happening in the macro, we had a lot of folks move into this space that were chasing a quick buck, candidly, and they were looking for, launching a token quickly and really sort of exiting from there. Those folks, thankfully, I think are gone now. And very, very candidly, we've lost a lot of talent to AI. I think, again, if you're a 20-year-old sitting at Stanford, crypto is probably not the first place you're looking. You're obviously looking more at things like AI as being maybe the new exciting frontier. But where we have gained talent is there's a lot of people from Wall Street. There's a lot of people who are coming from traditional finance that are just waking up to ways that this technology can really transform the stack and can really disrupt their businesses. So I think, a lot of the infrastructure early phases of this, industry, some of that is behind us, and now we're moving more into, some of the more kind of financial talent, some of the people that are coming in from those more traditional industries to take us maybe more down the adoption curve.
And on the flip side of that, right, then we also see a lot of Web 2 funds now starting to take interest in crypto or blockchain-enabled startups. So I'm curious, how do you think pitching to Web 2 funds might differ from pitching to a crypto fund? And how does this really change the crypto landscape?
I will say it's unsurprising. I think as the industry matures, we started off as essentially a shadow system, right? It was, it was very unclear sort of where we fit in the broader sort of traditional markets. Regulation was highly unclear. There was obviously outsized risks, in those early innings. I think we're at that point where we're growing up as an industry, and more kind of traditional pools of capital, especially with some of the regulatory changes, are starting to pay real attention in terms of how, again, crypto can disrupt their various businesses. So I think we're at that point where if you're a fintech investor, you are paying attention to what's happening with tokenization. You are paying attention to what's happening with stablecoins. Because you're watching likely in the next 2 to 3 years the entire kind of payment stack completely collapse, right? And so because of some of those, again, competitive forces, they're almost forced to look into our space and take note of some of the innovation. I think broadly that's very good for crypto founders. I think there are deeper pools of capital in traditional venture capital. There is more plentiful upmarket capital that's going to be available to them, especially in categories like fintech. So I think broadly I view it as a win. Where it can be a little bit challenging is, obviously a more kind of traditional venture capitalist hasn't spent a ton of time maybe thinking about decentralized networks and some of the nuances that might be involved there. They maybe aren't used to this idea of opacity around sort of value accrual with different financial instruments. So you might have to do a little bit of educating when you're kind of interacting with non-crypto investors. That can be a little bit frustrating for some crypto founders. Whereas again, if you come to a more crypto native firm, I think all of us that are on stage here, you definitely don't have to kind of explain the history of crypto or kind of decentralized network stuff. So I think we're already bought in. But again, I go back to me, it's a net win to have these pools of capital available to crypto founders.
Can I add on to that real quick? So it was a great point, and it's that the deals today are much more palatable and understandable to traditional investors than last cycle. So last cycle, what was the big things? New L1s, cross-chain bridges, new forms of DEXs, things that are very hard to understand and very hard to underwrite, very complex value accrual, all the things that you mentioned. Versus now, what are the big rounds that are getting done? It's things like RAIN, that's payments, but under the hood, there's stable coins that are involved, but it's payments and credit cards and debit cards and issuance. It's things that traditional investors understand that tokenization and blockchains are going to be better rails for, but it's business models they understand versus the crypto native business models that were much more challenging for prior cycles. So we see a lot more of it now, also not only at Series A, but also at the seed level as well.
One more question for B. When a seed founder is thinking of graduating to Series A, how do they know that they're Series A ready, or what advice would you have for them running a fundraising process?
I think it's a tough question, going back to because there's no one sort of mental model of when are you ready. For most founders, it's when you need money is typically when they go out for their Series A. It's kind of oh, well, I need to. But I think it's, again, I go back to the more proof points you can have around inflection. on whatever set of metrics, right? There are businesses who say, okay, we're making a very strategic decision actually not to monetize, right? What we're focused on is building network effects or building our user base or building payment volume, you name it. Again, it depends on the complexion of the business. The more you can point to that part of the KPI being de-risked, the better you will be off, right? So I think it's, the more data points, the more traction, then the more, again, you can de-risk that for an investor, the easier the Series A conversation will be. There's also, I will say, again, we're making a lot of generalizations, but we've seen pre-seed rounds that are $100 million, right? It kind of depends. It depends on if you're a repeat founder, this is your fourth company, you have a track record of success. Your metrics can lag for a very long time because the bet is on you, right? That's the underwrite. If you're a business that, again, you went from 0 to $100 million of revenue in a very short period of time, the underwrite is the growth, right? Like that's like what people are kind of underwriting, is that one growth metric that they can point to. So it's a little bit varied and a bit of a cop-out answer, but it is more bespoke than I think a lot of founders realize.
That makes sense. So we have 5 minutes left, some rapid fire questions for the group. So think maybe like single sentence answers. 3 questions. The first is, how do founders get in the room? So what is your top sourcing channel for pre-seed, Richard?
For me, it's usually intros from founders that I've worked with in the past or like other VCs. I'm usually 1 degree connected from like any founder in crypto, so it's pretty easy to get an intro.
How about you, Carl, for seed?
I would say that, and by the way, warm introductions are the #1 way. So find somebody who knows me or anyone at 6 Man Ventures or any venture firm. By far, your deal is going to get much more attention than if you just come in cold. But also conferences. I've met like 2 or 3 teams here that I thought were really interesting. I always try to make myself available and be present at developer hacker houses, conferences, at any sort of event where developers are going to be is where I try to spend time.
How about for the Series A and beyond Class B?
Yeah, I think we co-invest quite a bit with a handful of firms. So if it comes through those channels, it's probably the easiest. I will also say we really love outbound, meaning if you hear from us, it's typically because we have a thesis and we have been paying attention to your company. So that, I would say, #1 way to get through the door is to be very thesis aligned with what we're trying to invest behind.
Awesome. Second question. So historically, tokens really mattered, right? Because it was a quick path to liquidity. How important are tokens to you today? Or the having a tokenization path?
Well, tokens have like underperformed significantly. I actually keep a spreadsheet tracking every TGE. So there were about 160 TGEs in 2025. Of those, about 83% are below their TGE price, and about 1/3 of them are below the price that seed investors paid. So it's a very tough market for tokens. I think there's less appetite for tokens unless there's like revenue backing the tokens. Like what we see with Aave, Morpho, Ondo, a lot of the blue chips. I think that's the state of tokens.
I'm old school. I love tokens. I think that this whole like tokens are dead is an overreaction per usual in crypto. I just think the token models need to evolve, right? And we're seeing the first wave. I think Richard's kind of alluding to it. Is you can't have a token that's basically just a governance or a utility token. It needs to tie back to something, right? There has to be some fundamental mechanism for why it has value. So I think the Uniswap sort of fee switch moment was a really big moment for our industry. There'll be lots of other attempts to tie back sort of the fundamentals to this financial instrument that is the token. And then I think we'll be in good shape.
Cool. Any other thoughts, Carl?
Yeah, I mean, tokens are incredible at bootstrapping adoption and bootstrapping community. And so they are very powerful, but if you don't have a reason for your token to exist that accrues value or creates massive amount of value to the protocol, then you probably shouldn't launch it.
Awesome. Last question. Ton of founders in the audience. Name one specific business or model that you would love to fund, but you just haven't seen a good pitch for yet.
I say probably my highest conviction non-consensus bet right now is non-USD stablecoins and on-chain FX. I think people write off the market for non-USD stables because it's very small today. But I think as stablecoins get used for stuff other than just crypto trading, so like cross-border payments, FX, remittances, we're going to see demand for euros, pounds, other stablecoins. Dollar dominance in TradFi is about 83%. In crypto right now, it's like 99.8%. So just a little drop in USD dominance is going to cause the market for non-USD stables to explode.
I would say data verifiability, whether it's in the form of images or text-based data, et cetera. In an age where AI can create anything, and the typical rules we use to evaluate data, such as PageRank and things pointing to each other, that doesn't work in an age where you have like hundreds of millions or billions of agents. So actually being able to prove data and its provenance is something that is very underappreciated, but it's the perfect use case for crypto in an AI world.
I would say on-chain prediction market. I think we've seen what the Binance and the Coinbase version of them look like, which is these centralized versions of a prediction market. But if someone can crack the design space around essentially creating the Uniswap of prediction markets, I think it would be a really novel design. So would love to find that.
Well, thank you so much. Would love if you guys could give a round of applause for our amazing panelists, B from Faction, Richard from Barrick, and Carl from Six Man Ventures. And we will now move on to the next panel. Thank you all for being here and sharing all these insights.
Thanks for the great questions.
From Multicoin. Whenever you're ready, please join us on the stage. And Perrine from Nitro. Awesome. So this is panel 2. We are now talking about the great debate, which is requests for startups. The first question, obviously, is just going to be level set us on who you are and what your firm focuses on and what the sweet spot is.
Yeah, absolutely. So my name's Spencer Applebaum. I'm a partner on the investment team at Multicoin. We actually published our firm level thesis a couple weeks ago, and if I had to summarize it quickly, it is that we believe blockchains are the first principles correct way to move money globally, organize capital formation, and power global trading markets. I think we've learned a lot since we started just about 8 years ago, and I think we've kind of come to the determination that stablecoins and payments and finance are really what blockchains are primarily useful for. So, yeah, that's our strike zone.
Perrine?
Hi, I work for Monad Foundation, lead founder initiatives. So that's a bunch of residencies and the Nitro Accelerator that we've just launched. To give you a quick one-liner, I think we agree a lot with what Multicoin thinks. Monad being a general purpose chain, we still see a lot more activity on the payment side. DeFi building blocks are still to be built in Monad, so there's a lot of competitive opportunities there. And ICM is one sector that we are pretty bullish on, apart from on-chain social. On-chain social is just my personal interest that I think was not very well done till now, and a breakout app that's consumer app would probably be an on-chain social app. So.
Thank you both for that. So I'm going to start with Perrine because this is sort of the first week that he's announced the Nitro Accelerator, which is a brand new crypto accelerator that is chain agnostic. So we'd love for you to tell us a bit more about this accelerator. It's in collaboration with a bunch of VCs like Paradigm, Electric, Dragonfly, and more. What's the origin story of this accelerator, and why did you decide that there was a gap in this market?
So, I mean, I've been building accelerators or working with accelerators for a very long time. Last 8, 9 months or so, we studied all chain accelerators, and frankly, no breakout companies ever come out of chain accelerators. It's very easy for the foundation to spin up, give, allocate some capital, and say, okay, here's the applications, come run it. Mostly it's run by chain people, which means that we are looking for founders to fill in gaps in our ecosystem. So let's say there is no prediction market on Solana, so they will get one in Colosseum. We don't do that. We realize that the only accelerator that actually has worked is Alliance, and they do pretty well, primarily because founders go there for actual network. Chain accelerators by default have adverse selection, so you are never going to be part of an elite network. That means getting 100K, 200K from some chain accelerator is not interesting for the best founders. And then what we decided is, let's be credibly neutral here. Let's not run it ourselves in the sense that we are completely in control of it because we have bias. So we got in these amazing VCs to contribute capital, created a separate accelerator brand, and they're going to be involved right from selection to program. So of course, Monad Foundation funds it and runs it, and we will shell Monad to the founders, but there's no contract saying you have to be deployed on Monad. There is no obligation to deploy on Monad. If you are a great founder building on any chain, you're welcome. Nitro is a network, and we want the first batch to be the most kick-ass batch because that sets the tone for everything else.
Yeah. So what do founders get, and what sort of startups make the best fit for Nitro?
Yeah. Founders get $500,000 from these VCs, and that's a 10 mil valuation token, 5 mil equity valuation, much better than what any accelerator in crypto, or probably very comparable to the top accelerators in Web 2 as well. So you get that day one. When you land on the program day, you get all of that money guaranteed for every team. Second thing is, what we realized is that we need a bunch of builders who've done things before to come and work with these founders. So thankfully, we have a program in New York, which is full of amazing builders and investors. So we've invited them to work with us for a month with these founders, and that's I think one of the biggest value adds. And the third thing is, from Monad Foundation side, one thing that we can provide is top tier growth support for these teams. That's something that Alliance and most other accelerators can't provide. Chain accelerators have a ton of attention, but not great mentors or programs or money. And non-chain accelerators have great programs and network, but they don't have attention. So Nitro is an attempt to bridge both of these things at the same time. And we've got 320 applications in 10 days. And I think 35 companies are already significant revenue making, not trivial revenue. So the bar is pretty high, and we are extremely excited about this.
Thank you. I have a couple more questions for you, then we'll turn our attention to Spencer. But the first question is, you mentioned that you've also opened the door to AI founders. Would love to understand how you see the world of blockchain and AI colliding.
So I think it's not like we want pure LLM builders or an AI product that's solving a small SMB problem to come in. Ideally, what we believe is most AI players will have at least payments in some form, especially if they are building agentic apps. Then there needs to be X402 or something else that comes up. If that's the case, then we want them here. Our aim is actually to just support great founders, reach PMF as soon as possible. We do believe that greatest of founders don't need tactical support. Like, we don't need to teach them DeFi if they're building in DeFi, or we don't need to teach them tech. If we need to teach them that, then they're not great founders in the first place. So.
And you mentioned you're really excited about on-chain social, but obviously on-chain social has taken a huge hit, right, with the Farcaster acquihire and all these other apps sort of
Lens.
pivoting, yes. So we'd love to understand, is there a social 2.0 you're looking to fund, or what's your consumer thesis?
I can definitely say I would angel invest 25K in anyone who's building something that's permissionless and has an open source client. It's a protocol. Farcaster's biggest problem was the protocol was sufficiently decentralized. It was not technically permissionless in the first place. And they killed all the clients by acquiring them. The model to look at here is WordPress. If anyone has studied WordPress, is old enough as me, then you know the core is permissionless, minimal, and open source. And the innovation happens on edges. So if I could spin up a Farcaster client and say, let's use this for my college alumni today, actually that would have been way better. But somehow rest of the clients just couldn't compete with their core client because core client was always evolving and it was not open source, which is antithesis of a permissionless social network in the first place. And I do believe that the innovation is in the algo. Elon Musk, Nikita Beer, both have said this. Algo is what is pissing off everyone right now. We know it's polarizing. So on-chain social has the best shot at telling me, show me less Trump, show me more something else, less sports, something like that is very, very possible. Just couldn't build it on Farcaster. And I can say I tried it as well with a bunch of people 2 years ago. It just didn't work out.
Thank you for that. So now I'm going to move on to a bunch of questions for you, Spencer. And this section I kind of like to think of as like the hard truths of what's happening in the crypto market right now. The first is about infra. Block space is obviously commoditizing, and funding for infrastructure has really dropped. Is the infra build out done, or do you think there's some missing layers still?
Yeah, I don't love the idea of homogenizing infrastructure as a phrase. I think, as you alluded to, block space is completely commoditized at this point, and I think if you're trying to build a new general purpose layer 1 or layer 2, it's going to be really hard, and I think crypto capital markets generally have shown that they're not particularly interested in funding them anymore, and the public's not particularly interested in buying them anymore. I do think, though, there are, there's a few exceptions on the chain side. First, I think, application-specific chains, the most obvious use case being a high-performant derivatives exchange like Hyperliquid and Lighter. I think there still are opportunities there. And then two, I think there's still a lot of infrastructure outside of block space that still needs to be built out. So, on the stablecoin side, there's a lot of stuff that needs to happen around, compliance, identity, like wallet abstraction, just a lot of things that still need to be built there. And then I think on the market microstructure side, there's still a lot of things that need to be built, like, on-chain performant order books and DeFi prime brokerages that can improve capital efficiency and, things that can combat toxic order flow on-chain, which has obviously become a huge problem. So I think, base layer or L2 scaling at this point is kind of table stakes. And like, if your pitch is we're really fast and cheap and we're a general purpose chain, I just don't think, I think we're past that in the cycle.
Makes sense. Next hard question. The sentiment on altcoins are at an all-time low. Would love to understand, how you think about the altcoin market, if it might return, or what kind of altcoins are really catching a bid today.
Yeah, I hate to sound repetitive, but I also hate the idea of homogenizing altcoins. Yep. I think there are many different flavors of altcoins. I think the industry, and I think someone said this on the previous panel, if I'm not mistaken, I think the industry is generally moving towards show me the revenue, and show me the value capture, and show me the moats. And I think, crypto over the last, 5 to 6 years got used to projects that didn't have great answers to all three of those questions launch at multi-billion-dollar valuations, and then, once the unlock hit, everyone sold. But I do think there are lots of altcoins, I don't love that term, but lots of altcoins out there where the protocols are generating real revenue, they have network effects, they're compounding, and obviously in bear markets correlations go to 1, which is what we're seeing. But I think over time that is going to change, and you're going to start to see divergence between high quality names and low quality names.
Thank you. So let's talk about stablecoins, right? I would say a lot of people argue stablecoins are the killer app. So we also see Stripe and other Web 2 companies sort of come in, entering with existing distribution that sort of absorb this innovation. So I'm wondering, where do you think the startup opportunity is for stablecoins?
Yeah, I feel like I've heard a lot of people say that, you know, the Stripes of the world coming in are kind of going to kill the crypto native companies that are working on stablecoins, and I actually view it the opposite. I think it's validation more than anything else. I will say there's this whole trend right now of what I pessimistically call corporate chains. So things like Tempo and Arc and Canton and Robinhood Chain. And I'm like generally skeptical of these efforts, primarily because, you know, if you're Adyen, for example, like I just don't see a world in which you're going to be willing to launch on a chain that's controlled by Stripe. Or if you're E-Trade, I don't really understand why you're going to want to build on Robinhood Chain. And so I think if you want to sufficiently attract a large group of third-party developers, liquidity, et cetera, I think there's value in being neutral at the base layer. In terms of where we're seeing opportunities, I think there's like opportunities everywhere in stablecoins. The first one I guess I'll highlight is we published a blog post a month ago, I guess, and it's called Specialized Stablecoin Fintechs. And basically our thesis there is, if you look at the history of fintech, there's really been, you know, 3 historical eras and now a 4th one, but Fintech 1.0 was bringing finance online, so companies like PayPal and E-Trade. Fintech 2.0 was neobanks that, you know, built specific products for specific customer segments. And then Fintech 3.0 was embedded finance, so, you know, basically putting fintech into all of the applications you use today, whether it's Uber or something else. I think Fintech 4.0 is stablecoins and permissionless finance. And what's amazing about that is I think it's going to take us back to the days of neobanks. But the problem with the first iteration of neobanks was their margins, because of the rails that they were built on, card networks, correspondent banks, you know, just like a bunch of crap. Their margins were not as good as they should have been because there were so many intermediaries underneath that they ended up having to expand even though they really shouldn't have. And so the amazing thing I think now is we can have specialized fintechs that build specific products for specific groups of people. You know, it could be 10,000 people, but their unit economics are going to be so good that you can actually build a venture scale business in that way. So that's like one area in stablecoins we're excited about. The other area is something that we call more efficient credit. I wish I had a better name for it. If anyone has any ideas, let me know. But we're starting to see this trend, and I think it's probably going to be one of the biggest themes of the year, which is DeFi vaults. But DeFi vaults today are really just built in a very crypto native context. So therefore, giving leverage to market makers and doing, you know, juicing yield farming and things like that. I think the vault structure, though, itself can actually be expanded to non-crypto specific use cases. So things like financing YouTube creators, or like what Daylight Energy is doing with financing energy assets. So I think creating a global pool of capital with localized curators who can allocate capital in more efficient ways using stablecoins is like probably one of the biggest opportunities in crypto today, and something that we're really excited about.
Stablecoins, everyone's excited by, but what else is interesting, new primitives in DeFi today?
In DeFi specifically?
Specifically, or, well, sure, DeFi specifically.
Yeah, I think this isn't going to be that specific of an answer, but, well, actually, I'll give you 2 answers. One, I think there's still a lot of primitives that need to be built out to support the next generation of assets that are going to come on chain. Like, if you look at the history of crypto, we created extremely over-collateralized borrow-lend protocols because the collateral was extremely volatile and it didn't generate cash flows. And everything was fungible. So we ended up with Aave and Compound, which at the end of the day are great products, but I don't think they're particularly useful for a lot of the assets that are going to come on chain in the future. So maybe order book based lending would work better, and like that's interesting. Or fixed term and fixed rate lending still haven't really reached any amount of scale on chain. So I think there's like new primitives that need to be built out. And then on the other side, like the actual issuance side, we're extremely excited about all sorts of traditional assets coming on chain, whether it's equity, private credit, FX, commodities, real estate, whatever. I do think that, I keep saying homogenizing, but I'll do it again. I think homogenizing real world assets into one bucket is generally not useful, because I think the go-to-market functions and the regulatory frameworks around all of them are very different and unique, and they're all going to come on chain in different ways. But that's something that we're really excited about, and actually we're working on a thesis right now to share publicly about how we think each asset class is going to come on chain, and like the path dependencies associated with all of them.
One more question for you, and this one is really about DePIN, because Multicoin was one of the earliest backers of DePIN. How do you view this evolution of real-world physical networks in 2026?
Yeah, I think we were probably one of the earliest, if not the earliest, investor in DePIN. We initially invested in Helium in the summer of 2019, and since then I think we've probably backed close to a dozen DePIN networks, some of the most notable ones being HiveMapper, GeoDNet, Fuse Energy, and Arweave, and some others. I think DePIN is in, candidly, like a pretty tough spot right now, and I think the reason for that is they're very cyclical and, I guess, flywheel driven, in a sense that when token prices are going up, it's a lot easier to convince the supply side to join, which then creates a flywheel where you get more demand that leads to increased token price, and so on and so forth. Because correlations go to 1 in bear markets and DePIN assets are down just as much as everything else in crypto, if not more, I think it's in a tough spot right now. I will say, I think the other challenge for DePIN today is there hasn't really been like a North Star success case in the sector where, if someone's building a company in, it doesn't even matter, let's just say logistics, they can't look at a DePIN network and say, oh, this company in this sector built a DePIN product, scaled it to 100 million of revenue, and I can look at that, apply the same capital formation model to my own sector. And so I think, we have our views obviously on what could be that North Star, but we're just not there yet. But it is a sector that we remain extremely excited about. So that's kind of where I sit right now.
Awesome. So we're going to do some rapid fire, overrated, underrated questions. I'm going to name a sector, and you just say overrated or underrated. No explanation.
No explanation. Okay.
Unless you want to give an explanation. But crypto AI.
Underrated.
Fairly rated.
Oh, that's a good addition. Okay. Prediction markets.
Underrated.
Underrated.
Bitcoin L2s.
Very overrated.
Extremely overrated.
Wow, a lot of consensus here. Privacy.
Underrated.
Yeah, same underrated.
Okay. Gaming.
Overrated, but I don't know if anyone actually thinks it's great right now. But yeah, overrated.
I would definitely say it's underrated in terms of market cap that it needs to achieve just to free up the assets from Web2 gaming companies' treasuries at this point. So the market cap to be acquired is much, much higher.
So gaming is a really controversial one, because if you actually look at funding data, there's been a ton of funds that still go into gaming still for Web3, which you just wouldn't expect, right?
I can tell you we're not.
Yeah. Okay. Decentralized DeSci.
Ooh, underrated.
Underrated.
Underrated in long term for sure, but I think most of the projects right now are just not doing shares.
Strong agree.
SocialFi.
Overrated.
Extremely underrated. I think this is my personal bias. Don't think Monad Foundation is so bullish on it, but I'm extremely bullish on this.
I'm curious, Spencer, why social fi in general is a overrated category for you.
I think it really just comes down to what we at Multicoin view as like the primary raison d'etre for blockchains, which is movement of money, capital formation, and trading. And I don't think that there's really a great place for any of those in SocialFi. I do think that like there are some interesting things around embedding DeFi and payments into existing social apps, and I know we're going to see what Twitter X now does, but I do think there's a massive opportunity there. But like convincing people to switch from the networks they're already using, I just don't see personally why blockchains are like a good reason for people to switch and like what they actually offer that the existing ones don't.
Makes sense. Okay, so this is the same question from the last panel, but how do you source your deals? Like, what is your highest avenue for channel for sourcing?
For us, I think it's our list of referrers. Since this is the first cohort, and generally at Monad Foundation, I think when someone comes in with a reference from someone that we know and we trust, it makes everything simpler. It's very difficult to filter otherwise based on mostly like founders' intent is what we are looking for. Smartness is the secondary thing. If they are looking for a short-term thing, then even the smartest founders, we really hesitate in working with them. So I think references is number one out there.
And Nitro is a little bit unique in that they actually list who they care about as referrers on their website. So
yeah, they're on our website. Yeah, they're on our
if you're
website.
looking to apply for Nitro, take a look at who their referrers are and get a referral that way.
A
We
lot
might
of them.
copy you on that.
Eli from Multicoin is our referrer.
Oh, there you go.
Yeah, so
Spencer, how do founders find you?
Yeah, I think it's evolved over time. I tell people this and they never believe me, but of like the 5 best deals we've done in the history of the firm, I think 4 of them came through Twitter cold DMs. So definitely VCs, if you're listening, keep your Twitter DMs open. There's a lot of alpha that you can generate from having them open. I think at this point, I echo a lot of what he said. Referrals from existing portfolio founders, I think, is probably the highest signal. Is the highest signal way to get deal flow. Just keeping a network open. I think at this point we have a pretty big brand in the space. So I think a lot of it at this point is inbound, but of course we go to hackathons, we go to conferences, just chat with people. Yeah, nothing too unique, I would say.
If you have a request for startups, so basically complete the sentence. Someone please build X because I will fund it immediately.
I think I already said that. I already said that for sure. Please, if you're bringing on-chain social, take an angel check from me at any point in time.
It's funny because the founder in the crowd right now listening is doing somewhat similar to this. But if you're building a instantiation of DeFi vaults for real-world use cases, I'm extremely interested in funding that.
Awesome. I just want to conclude with Pareem basically announcing the deadline and the Nitro application process, since we just had him announce it this week. So for founders in the room looking for some accelerator funding, tell us how you can apply.
Thank you. We have Nitro acc.xyz, or if you search Nitro Accelerator on Twitter, you should be able to find it on one of the Monad handles as well. The deadline is pretty far. It's actually 14th of March. The reason why we did that is because we want live products for sure. You can deploy it on any chain, feel free. I think 50% of our applications are Solana startups at this point, then Base and then Monad. So don't worry if you've deployed on any chain. We want you get 100 users with retention. If 100 users are using your app on a weekly or a daily basis, we are extremely interested. So shipping and retention are the only 2 things that we check here, frankly. and apart from that, get any references, as many references as possible. They're all listed on our website. Everything is listed there. And what I would say is super excited to have founders who are building something very long term, right? We want this to be a group of people that grow together. That's the only thing you can get out of it. 500,000 is a bait, frankly. If you need $500,000 to survive or to grow, then you're going to get rejected. If you don't need $500,000 and you're coming in for the network, that's where the most chances of selection are going to be. So our headline is you don't need an accelerator. If you do, absolutely, then we have a lot of competitors I can refer you to. Please join one of them. They'll give you money for sure.
Thank you both. Thank you for all the insights, for being here. Again, Spencer from Multicoin and Pareen from Nitro.
Thank you.
Thank you, Tina.
All right, we're going to take a few minutes to turn the room. Up next is going to